Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that has just been a fascinating market to watch over the past few months. Let me just remind you guys, we are heading into the first monetary recession since 2008, and we need to find out how we can successfully navigate the stock market in that type of environment where end of cycle returns are typically massive, right? Towards the end of bull runs, you tend to have an acceleration of that trend that you had throughout the past few years for many reasons that we've discussed in our videos, but where the risk is also tremendous, where you're getting closer and closer to that big top, or at least what we believe is going to be a big market top over the next few months. If you're interested in following these crazy markets with us, make sure to click on that subscribe button. If you enjoy this episode, do not forget to smash the like button, and also make sure to stick around to the end of the video because I do have a quick announcement to make. We're currently in the process of hiring more people and adding more talent to our company to expand the services that we provide. So if you're interested in participating in that, make sure to stick around to the end of the video. Alright, so now I want to begin by quickly taking a look at the short-term stuff on the S&P 500. Now, I know that, we say again and again, we try not to focus on the short-term price action of the S&P 500, but we did make a few calls recently, and I want to cover how these developments are going, right? We had a nice line of resistance here. We were watching this zone of resistance here, lots of big resistance. The markets tried to break out, but they were incredibly overextended. We took a look at that overextended RSI reading, and every time you get that type of extreme reading, it signals a short-term consolidation or a short-term correction, even if it doesn't mean the end of the uptrend, right? You do get a little bit of a correction, and this is exactly what we got here. In fact, in one of our previous articles that we made on the S&P 500, we took a look at what was happening with the volatility index of the S&P 500, and we took a look at this trend line. Don't pay attention to all the other trend lines, just pay attention to this one right here that captures this bottom from November, January, and potentially we were testing that towards the end of March. Now let's zoom in and quickly try to make sense of this technical picture, right? Tightening was announced right here when this trend line was formed. This is when the Federal Reserve started to get hawkish on the market. And ever since then, we've had volatility bounce up and down above this trend line, right? So ask yourself, has anything changed since this trend line was formed? If the answer is no, then there's absolutely no reason that we should see a breakdown. And in fact, the answer is no. They're still announcing tightening. They're still getting very hawkish. And so the probability would be to see a bounce off the VIX, which could set off a pullback on the S&P 500. If we take a look at this interactive chart, one of my favorite features of the website that really lets you take a look at how these charts and setups played out and see for yourself how these technical levels actually work and how well they're respected. Let me press that play button and you can see nice bounce on the VIX, which triggered that small correction. So if you took a look at the VIX, you would have been able to time the recent top on the S&P 500 within half a percentage point. Now again, considering our entire service is aimed towards helping people to become profitable in the market, we don't focus on these types of trades. The reason I put this in the article is to show the members that, despite the fact that we're super bullish on the market right now for many fundamental reasons, this was not the time to enter, right? Objectively, this was a moment to actually be taking some profits off the table on the S&P 500. So how low is this pullback going to go? In that article, we talked about a few support levels that we were watching, including 4,300 that marked the bottom of this correction here. So that's pretty strong support. This correction back in September. So, this is going to be a strong zone of demand. I don't know if we get there, but if we do, we're going to be taking a look at that very closely to see if we should be adding to our long positions. Now, let's stop with the short-term picture and focus on the big picture stuff because, at the end of the day, that's what the trade is based on. And it all boils down into one fundamental question. Is the Fed going to follow through on their tightening? They're announcing, I believe, around 8 rate hikes, or at least the market is expecting 9 rate hikes right now. If they follow through on all that tightening, the market is not going to rally. We might see some volatility, but really there's no chance that we get back to the all-time high. We're going straight down. Right, we might have a little bit more of a bull trap, but in this scenario where we see 8 rate hikes in 2022, the market is not going back up to its all-time high. So I truly believe it all boils down to that one question: is the Fed going to follow through? Because if they don't follow through, a lot of the fear and anxiety that we've had in the market is going to evaporate, and it's going to turn into a lot of optimism, and perhaps at one point too much optimism. And this is typically how things play out during the end of a cycle. Towards a recession, you start to have the Fed realize that we're going into a recession, like in 2006, like in 1999, and like here in December 2018, and you get final rallies before the economic weakness starts to materialize and trigger a bear market. And this is massive equity performance before that big top. Now, COVID was a big top. I was in the camp that expected a bear market if we had not had the virus, where central banks needed to step in and create an economic boom. I believe we would have had a classic bear market, classic recession type of scenario. So that's exactly what I'm going to do in this video. We're going to try and answer that question with charts, with data, with statistics, and try to look at this objectively. I know there's a lot of pushback on the things that we've said over the past couple of weeks talking about this scenario where the Fed backs off. A lot of people saying that, there's no chance that the Fed is going to back off and that they'll have to raise rates to 8% to match inflation. And it is just so awesome getting all of that feedback, all of that constructive criticism from you guys. So it is really appreciated. It really helps us put into question the research that we're making and look at things from all potential angles. So the first big chart that I want to take a look at that's going to give us an idea of where inflation is going is this one right here. This is the Purchasing Managers Index, and this is basically an economic indicator that oscillates up and down. When it's very high, that means business conditions are incredibly good. When it's very low, like here in 2009, that means, economic growth is very, very slow. In fact, here it's negative. And this tells you just so much about what you can expect in the market, what you can expect around inflation, because you can see it's cyclical stuff. It goes up and down, and you can see more or less where we are in that cycle. We're post-peak, and we're declining pretty aggressively here. So let me zoom out on this chart and take a look at the Fed funds rate. And, this is going to give us an idea of what the Fed does when PMI is declining like it is right now, right? What's happening when you get this type of move down? You get a peak in the Fed funds rate. It happened back in 1974 right here. Decline in the PMI, peak in the Fed's funds rate. I'm going to come back to this period in just a second. Here, PMI goes down, peak in the Fed's funds rate. Same thing again. PMI goes down, peak in the Fed's fund rate. And notice, it doesn't matter where the Fed's funds rate is, right? It gets lower every time in this region. It never gets back to that old high. Decline in the PMI, peak in the Fed's fund rate. Here it was slightly higher, decline in the PMI, peak in the Fed fund rate. It, of course, happened in 2008, decline in the PMI, peak in the Fed fund rate. And here we have many, many reasons to believe that the PMI is going to continue to go down. The dollar has been strong. We've had yields rise incredibly quickly, which puts pressure on demand. It puts pressure on credit. We've had oil that's been strong that puts pressure on consumer spending. So the PMI is not going up, it's going down. So we shouldn't look for a rising Fed fund rate. We should look for a top in the Fed's fund rate. Now, there's two periods I want to address before we move on to the next chart, and that is this period right here, where clearly you had a decline in the PMI and the Fed's fund rate continued going up and up and up. Now, guess where this was? this was exactly when you had Paul Volcker as the Fed chair, where he literally came into office to stop inflation. That was his number one mandate. He said he's going to stop it no matter what. Now ask yourself, is Powell really a Paul Volcker? Does he really have what it takes to tighten into recessionary signals, to tighten regardless of how weak economic data is? My guess is that Powell is not Paul Volcker. Now here we have a couple of periods where you had the PMI decline, but the Fed fund rate was still at 0. And so guess what this corresponds to? This corresponds to QE, right? Another QE here. In 2016, they lowered the tax rate, which created an economic boom. That's not something they can do right now. So when the Fed funds rate is already at 0, they do QE or they do stimulus when you have that weakening economic data. Now, I just want to show you one more thing on this chart of the PMI because it's so fascinating how much this can predict what's going to be happening. We're going to compare the PMI to the inflation rate. And you can see here, for example, you have a peak in the PMI, and that was in February 1969. You can see at the bottom there, February 1969. Now let's check where inflation peaked. It peaked in February 1970. Now let's see where PMI peaked here in November 1973. Let's see where inflation peaked November 1974. Here PMI peaked in April 1979, and the inflation rate peaked a year later in April 1980. So I think you're starting to get the point. When you have the PMI peak, you can start to expect some type of a peak in the inflation around a year later. Now let's check out where PMI peaked here in 2021. It peaked in May 2021. So could we see in May 2022, meaning that the June 2022 inflation reading is going to be lower for the first time since the beginning of the pandemic? That would be huge. That would be a massive driving factor for the markets to rally. That's what the market is looking for. It's peak inflation, because that's when the Fed can step off the brakes and start to look towards weakening economic data instead of inflation. They just need that one reading. And you can see in the 1970s, where inflation was incredibly hot, you had the Fed funds rate peak at the same time as inflation. It peaks at the same time as inflation, except for when Paul Volcker was around. So I think you're starting to get the point here. It doesn't matter where the Fed fund rate is right now. If you get a peak in inflation, which is something I think that we're going to get sometime in the next few months, you're going to get a peak in the Fed fund rate, which is something that no one really is expecting right now. So that really strengthens the case for that final bull run on the S&P 500. But again, it can take time, right? We're talking about May or June here before that happens. Could we see more volatility until the market really begins to sniff out peak inflation and peak Fed fund rate? Absolutely, right? Could we even get a lower low? That's not out of the question. The point is, we don't think we're going into a bear market right now, and that the real top of the market is down the road. Now, of course, we cover all of this in our articles on gameoftrades.net, where we take a look at the important developments. And this is something I wanted to show you, the technology sector that we think is going to be a big outperformer in this rally, because in end of year cycle rallies, you have tech outperform massively, and we've been looking for a correction in this chart. This is the Nasdaq divided by the S&P 500, and you can see on this recent bounce we've had massive tech outperformance, but you can see something we mentioned in the article. 10-year has been rising very aggressively, and so that could lead the tech sector to give back some of the outperformance we've seen. And so let's press that play button, and you can see, of course, we've had a nice move down on this chart here. Let me zoom in. Massive move down on the Nasdaq relative to the S&P 500. So we're going to be looking at this very carefully for buying opportunities if the S&P 500 and the Nasdaq come to interesting levels of support. If you're interested in following that with us, following these developments live, getting those notifications for these articles and trade setups that we're posting, make sure to click on the link down below and check out gameoftrades.net. Now, I did say I have a quick announcement to make. We are expanding our team quite rapidly at Game of Trades. There's a lot of demand and a lot of excitement around our service. And so if we don't expand rapidly enough, we're going to have to start putting waiting lists to have access for new members to sign up to our service. So if you have a background in finance, if you have a good understanding of technicals, macro, cryptocurrencies, and intermarket, and you'll like the style of research that we put out, you're also creative, high energy, and you really have a passion for investing, make sure to check out the link down below to contact us about a job, especially if you're interested in having the opportunity to be part of a small but rapidly growing online investment research company. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed this one. If you did, don't forget to click on that like button. Now, in the meantime, I wish you good luck on your trading and see you next time.